Here is a fact that most people find genuinely uncomfortable. The wealthier someone is, the lower the percentage of their income they typically pay in tax. Not because they are doing anything illegal, not because they are cheating the system, because they understand a set of legal tax strategies that most ordinary people were never taught. The tax code in almost every country in the world is filled with legal mechanisms, deductions, credits, accounts, structures that dramatically reduce the amount of tax paid by people who know they exist. Today, I am revealing 7 of the most powerful legal tax secrets used by wealthy individuals worldwide and showing you exactly which ones are available to ordinary people right now. This is not tax evasion. This is tax education. And there is a very important difference. Welcome back to Broke No More, where we reveal the financial knowledge the system never gave you. Subscribe right now because understanding tax is one of the highest return on investment skills you will ever develop. Every hour you spend learning this legally saves you real money every single year for the rest of your life. The single most accessible and most powerful legal tax reduction tool available to ordinary people worldwide is the Tax Advantage Retirement Account. In the United States, this means a 401k or IRA. In the United Kingdom, an ISA or pension. In Canada, an RRSP or TFSA. In Australia, a superannuation account. Almost every developed country has an equivalent. Here is what makes these accounts extraordinary. Money contributed to most of these accounts reduces your taxable income in the year you contribute. The investments inside grow completely tax-free. And in some account types, withdrawals in retirement are also tax-free. A person earning $60,000 who contributes $6,000 to a tax-advantaged account effectively pays income tax on only $54,000. Depending on their tax bracket, this saves them $1,200 to $2,000 in tax immediately, every single year. Most people contribute either nothing or far less than the legal maximum to these accounts. Wealthy individuals almost universally max them out first before making any other investment. Action right now? Find out the maximum contribution limit for your country's equivalent retirement account. Then calculate how much you are currently contributing. The gap between those two numbers is tax you are paying that you do not have to. Comment below, do you max out your tax advantage accounts? Yes or no? This is the tax secret that most clearly reveals why the wealthy get wealthier while workers stay in the same place. In most countries, money earned through employment is taxed at income tax rates. In the United States, these range from 10 to 37% depending on your income level. But money earned through long-term investments, called capital gains, is taxed at a significantly lower rate. In the United States, long-term capital gains tax is capped at 20%. For many ordinary investors, it is 15%. For lower-income investors, it can be 0%. 0% tax on investment profits. Legally, this is why Warren Buffett famously noted that he pays a lower tax rate than his secretary. His income comes primarily from investments taxed at capital gains rates. Her income comes from employment taxed at income rates. The practical implication for ordinary people: every dollar you move from a savings account into a long-term investment is a dollar that will eventually be taxed at a lower rate when you sell. Building an investment portfolio is not just a wealth-building strategy. It is a legal tax reduction strategy. Comment below. Did you know investment profits are taxed differently from employment income in most countries? If you work from home, whether as a self-employed person, freelancer, content creator, or small business owner, you may be entitled to deduct a portion of your home expenses from your taxable income. The home office deduction allows you to deduct the percentage of your home used exclusively for business purposes from expenses including rent or mortgage interest, utilities, internet, insurance, and repairs. Here is what this looks like in real numbers. Your home is 1,000 square feet. Your dedicated office space is 100 square feet, 10% of your home. Your annual rent is $18,000. You can deduct 10%, $1,800, directly from your taxable business income. Add the proportional costs of internet, utilities, and insurance, and this deduction can easily reach $2,500 to $4,000 per year for many home workers. The key requirement in most countries: The space must be used exclusively and regularly for business. A corner of your bedroom where you sometimes work does not qualify. A dedicated room used only for business does. The fix: if you are self-employed or run any business from home, speak with a tax professional about claiming the home office deduction. In most countries, it is completely legal and consistently underclaimed. Do you work from home? Comment below. And did you know you might be able to deduct it from your taxes? This strategy is used extensively by wealthy investors and financial advisors, and is almost completely unknown to ordinary investors. It is called tax loss harvesting, and it turns investment losses, which feel like bad news, into a legal tax-saving tool. Here is how it works. If you have investments that have declined in value, you can sell them to realize the loss. That realized loss can then be used to offset capital gains you have made elsewhere in your portfolio, reducing your taxable gain. In most countries, you can also use investment losses to offset a portion of your ordinary income if your losses exceed your gains. Here is a real example. You made $5,000 profit selling investment A. You have investment B sitting at a $3,000 loss. By selling investment B and realizing that $3,000 loss, you now only pay capital gains tax on $2,000 instead of $5,000. Depending on your tax rate, this saves you $450 to $600 in tax on that one decision. The important rule: most countries have what is called a wash sale rule, meaning you cannot immediately rebuy the same investment after selling it for a loss and still claim the tax benefit. You typically need to wait 30 days before rebuying. Tax loss harvesting is completely legal. It is simply using the tax code the way it was designed to be used. Have you ever heard of tax loss harvesting before this video? Comment yes or no below. If you have any self-employment income, even a side hustle alongside a regular job, you have access to business expense deductions that employed workers do not. Here are legitimate business expenses that reduce your taxable self-employment income in most countries. Professional development, courses, books, subscriptions, and training directly related to your work are typically deductible. Equipment and technology, laptops, cameras, microphones, phones, and software used for business purposes. Professional services, accounting fees, legal fees, and business consulting costs. Marketing and advertising, website costs, social media advertising, and promotional materials. Travel, mileage, transport, and accommodation for genuine business purposes. The key principle: the expense must be wholly and exclusively for business purposes. Mixed-use items, things used for both personal and business, can typically only be partially deducted based on the business use percentage. Here is the practical action. If you have any self-employment or freelance income, start keeping every receipt for every business-related expense from today. In most countries, these deductions directly reduce your taxable profit, meaning every legitimate business expense reduces your tax bill. Comment below. Do you have any self-employment or side hustle income? And have you been claiming business expense deductions? Wealthy individuals use charitable giving not just for philanthropic reasons, but as a deliberate legal tax reduction strategy. And the same opportunity is available to ordinary people. In most countries, donations to registered charities are tax deductible. This means if you donate $1,000 to a registered charity and you pay 25% income tax, the government effectively subsidizes $250 of that donation through reduced tax. You gave $1,000. You effectively paid $750 after the tax saving. The charity received $1,000. Everyone benefits. There is also a more advanced strategy used by wealthier individuals: donating appreciated assets like stocks instead of cash. If you donate stock that has increased in value, you avoid paying capital gains tax on the appreciation and receive a charitable deduction for the full market value of the stock. This means you give more to charity at less actual cost to yourself, while simultaneously avoiding a capital gains tax bill. The practical action: if you already make charitable donations, make sure you are claiming them as deductions on your tax return. Many people donate regularly, but never claim the tax benefit they are legally entitled to. Comment below. Do you regularly donate to charity? And did you know you could claim it as a tax deduction? The wealthy do not just know about these tax strategies. They have a professional who proactively applies them every single year. Secret 7, and the one that multiplies the value of every other secret on this list, is working with a qualified tax professional who specializes in tax reduction strategies. Most people view an accountant as someone who files their tax return. Wealthy people view their tax advisor as one of the highest value relationships in their financial life. Here is the return on investment of good tax advice. A competent tax professional typically charges $200 to $500 for a tax planning consultation. If they identify $2,000 in legitimate deductions you were missing, they have paid for themselves 4 to 10 times over in a single meeting. The question to ask when hiring a tax professional: do you proactively look for legal ways to reduce my tax bill, or do you just file what I give you? The answer to that question tells you everything about how much value they will add. Final challenge. This week, look up one tax-advantaged account available in your country that you are not currently using. Just one. Research the contribution limits and calculate how much tax you could save by contributing to it this year. Comment below. Which of these 7 secrets are you going to act on first? I want to see your commitments. So there they are. 7 legal tax secrets the wealthy use that most ordinary people were never taught. Secret 1. Maximize your tax-advantaged retirement accounts every year before any other investment. Secret 2. Understand that investment income is taxed at lower rates than employment income. Build your investment portfolio accordingly. Secret 3. If you work from home in any self-employed capacity, claim the home office deduction. Secret 4. Use tax loss harvesting to offset capital gains with investment losses. Secret 5. If you have any self-employment income, claim every legitimate business expense deduction. Secret 6. Claim charitable donations as tax deductions and consider donating appreciated assets. Secret 7. Work with a tax professional who proactively looks for legal ways to reduce your tax bill. None of these strategies are secrets to the wealthy. They are simply knowledge that was never made widely accessible to ordinary people, until now. I have linked the best free tax resources and the books that helped me understand how the tax system actually works in the description below. If this video saved you money, subscribe right now. Every single week on Broke No More, we reveal the financial knowledge the system never gave you. Comment below. Which of these 7 secrets are you acting on first? I read every single one. You are not broke forever. You are just one move away. This is Broke No More.